Welcome back. We're joined by Jananda Vaidya, who is research analyst BFSI at Access Securities, joining us this morning. Great having you here. With regard to, of course, Kotak's numbers, talk to us. How do you look at the numbers? I mean, they were extremely strong, right? I mean, in terms of the margin increase, that was a bit of a surprise. The credit costs were also a bit of a surprise. So two surprises built in, and nearly every line item, Jananda, had a bit of positive bias to it, even outside of the larger surprises and the beats. And that's what really stood out. The question is, can this kind of performance sustain and are valuations attractive enough? I'll come to that, but give us your take first on the Q4 performance.
Sure. Good morning.
Very good
So
morning.
yes, of course, Kotak did report a very strong set of numbers. NII was in line with our estimates, but the positive surprise was the 13 basis points increase in margins. The highlight of this quarter clearly has been the lower fresh stress accretion and the improvement in asset quality. Now that is coming basically from the unsecured segments, wherein MFI and PL and credit card stress is on a downward trend, whereas the secured book continues to remain pristine. So here on as well, we see asset quality trends remaining favorable, and overall the outlook also on credit costs remaining fairly favorable and ranging somewhere between 70 basis points plus or minus 5 basis points. Yeah.
Jananda, if you look at what they commented about for FY27, they're looking at a flattish NIM or even slightly below NIM coming in on the back of the term deposit rates they have increased. Do you think, going into FY27, there would be competitive pressure on getting deposits?
Yeah, so of course that came as a surprise, a slight negative surprise. So margins will be impacted by the TD price increase. However, that should be partially offset by the improving trend in the unsecured book. And also the push for CASA deposits. Even in Q4, we've seen that Kotak has seen a very strong growth in terms of CASA, and that push will continue. It's not only for Kotak. We've seen a few other banks that have raised their TD rates to remain more competitive. Of course, the competitive intensity from a deposit standpoint continues to remain elevated, especially given credit growth has been ahead of deposit growth for most banks and also at the system level.
If you can also give us a sense of what's happening in the corporate book, and we've seen a slowdown coming in, it's growing at a very slower rate as compared to peers and competitors. Do you see this to continue? Because Kotak generally is a little conservative in lending in its corporate book. Do you think this will continue in FY27?
Yeah. So clearly the focus was on profitable growth, and where risk reward may not have been favorable, that is where the bank possibly hasn't really pursued growth in the corporate book. And to an extent that has also, we believe that has supported margins to an extent in this quarter. Going ahead, where in terms of profitable growth, the bank should see some improvement in corporate growth. And from a loan book standpoint, we believe that corporate SME and secured will lead growth for the bank. With unsecured now, the bank will push that pedal from an unsecured standpoint, though it will be more in a calibrated manner. Yeah.
Jananda, how do you read into the kind of commentary that came with regard to IDBI? Do you read into it very positively? They said that they would only go for acquisitions, and we know this. Kotak is very open to inorganic acquisitions, but at the right price. Did that stand out for you?
So that came in last quarter, wherein the bank said that they're very cautious when it comes to an IDBI acquisition. So yes, definitely that was an overhang, and we believe that the correction that we saw in Kotak, that was also a little sharper when it comes to its peers. So now that it's behind, the Kotak, the IDBI acquisition is now. It's not on the cards right now. So yeah, so that should be positive from a valuation standpoint also. And on a core book, valuations are fairly attractive for the 2% ROA delivery that it's sustaining. And barring ICICI, the larger banks, Kotak stands second when it comes to a 2+% of ROA delivery.
And, give us a sense of how you view this ROA trajectory. Margins might come in a little softer going forward. You believe that 2.1%, and mind you, credit costs were also sharply lower this time. You believe the 2.1 plus percent kind of ROA clip or 2% plus kind of ROA clip can still sustain? Because Kotak is known to do even higher than that. But I'm just thinking that, do they have enough levers to sustain this?
Right. So even though the commentary on margins and the trajectory is expected to be a little soft, what should compensate for the lower margins should be the operating leverage. So we expect a slight improvement in the cost to asset ratio going forward. If I look at a ROA tree, also the second lever that should help sustain the 2% plus ROA is the fee income. That has been a little soft this year, and that's mainly because of the slower growth in the card segment. Now with the bank pushing for better growth in cards, overall acquisition and spends as well. So the fee income should get some push there. And secondly, it's the credit costs. Basically, they were higher at the start of the year and they trended downwards. And now it should look more or less stable. And these three levers should more or less offset the impact that comes from the margins part. So the 2% ROA is definitely sustainable. Of course, it could settle somewhere at 2 to 2.1% over FY 27-28 versus a slightly higher ROA where margins were also higher that we've seen in the previous years. So yeah, but 2% definitely looks achievable. Yeah.
All right. Thank you so much, Jananda, for coming in and speaking with us. We'll let you go on that note. We'll bring on board